Thank you, VC Circle, for giving us this opportunity. And I hope so that for next 30 to 45 minutes, we'll leave some pieces of nuggets, some pieces of information, and a little bit of guidance how you can take advantage of something like called a venture debt. We are also very lucky here. It's not very often that there are only two venture debt funds in the country, Trifecta and InnoVen, and VC Circle has been able to get both of these guys here on one. How many times you have been here together or any panel together? This first time? So this is the first time when both these guys are on the same panel together discussing venture debt. So, so that's an interesting part. Let me also take one status check. How many people are here who are founders and who have taken venture debt in their companies or who have familiarity with the venture debt? How many founders are here who have taken venture debt in their companies? Okay, so we may have some interesting, either of them? Vinod? Okay, okay. So
thanks.
So hopefully there is a large audience which probably don't know anything about venture debt or very less about venture debt, and let's see. So we'll start a panel. We'll spend 5 or 10 minutes more, a little bit on technicalities, definition of venture debt, concept of venture debt. Personally, I think it's very lesser understood, not that much. There are a lot many questions on venture debt. And then we'll do a lot more Q&A, and you guys can ask whatever you want to ask. So Nilesh, taking you, why don't you just introduce yourself, your fund. How do you think this venture debt as a concept, how do you define it?
Thanks. So I represent Trifecta Capital. This is a 10-month-old firm, co-founded by myself and my partner Rahul Khanna. Between us, we have 45 years of operating, investing, and structured debt experience, and we've been entrepreneurs ourselves. And we realized that while the venture capital ecosystem was fairly well developed in India, companies were still struggling to raise, working capital finance or low-cost capital, and that led to the creation of Trifecta Capital. Our vision is to be the preferred provider of structured debt to the new economy businesses and be able to provide capital for different requirements, of these companies, whether it's, bridge finance or working capital finance or mezz finance, acquisition finance, and what have you. Globally, there are a handful of institutions who are very specialized and just focus on venture debt. Traditional banks typically are not necessarily the largest providers of venture debt. That said, we've been providing venture debt through a fund structure. It's a SEBI-registered fund, a Category 2 fund, which has a corpus of 500 crores. So potentially we can provide 1,000 crores of venture debt to startups. Since we started, we've already done about 14 or provided support to about 14 companies. And typical size is anywhere from 12 to 15 crores. Typical tenure is anywhere from 30 to 36 months. And I think, let me just, having introduced Trifecta, just step back and tell you a little bit about what really is venture debt. And the simplistic definition that I use is, it's structured debt to venture-backed businesses. I mean, I think that's the best way to describe, at least the products that are currently available from our platform and hopefully, InnoVen's platform. And typically we get involved in companies that have previously raised at least a Series A round of funding. It's rarely that we get involved in pre-Series A companies, and that's because we lend at fairly low interest rates, and we don't necessarily want to take venture capital risk. So that's for the venture capital funds. But once a company has raised at least a Series A, then we're more than happy to come in and support the company with low-cost capital and help them finance, as simple a thing as working capital.
Nilesh, you can also spend some time, like you alluded a little bit on that it can't be pre-Series A. What are the comprehensive criteria for you to invest, which is like tick box that Series A, you should have Series A. Is there a minimum cash in the bank requirement? What are the bunch of criteria for you?
Because this is a structured debt product, I don't think, we have criteria which are cast in stone. Every deal is very different. But that said, I think we're looking for businesses which are beyond concept stage. That's for the VC funds to take that kind of a risk. We're looking for businesses that are generating revenue, businesses that have high quality founders, obviously, have high quality venture capital funds, who understand the business and obviously have spent enormous amount of time due diligencing these founders and businesses, and then investing in these companies. Our debt is typically between 10 to 20% of the venture capital, equity that has gone into these companies. Some of these companies could be asset light, technology, services businesses. Some of the other companies that we are seeing are actually, brick and mortar. They might actually have a land building plant and machinery. But generally we see first generation entrepreneurs, we see businesses that are investing in growth and therefore not necessarily generating cash flows many a time. And, because traditional banks, are typically, they lend against personal guarantee of the promoters, founders, they lend against land building or hard collateral, and they're looking for cash flows to service the debt. Sometimes they don't even understand these new age businesses. So banks would typically not get involved in businesses like this. And so for the companies, the option is either to raise expensive equity or raise venture debt, which probably is a third of the cost of equity financing. So I don't know if that broadly answered your question.
I think I'll come back to it in some form of more questions. Vinod, can you introduce InnoVen, your definition of venture debt and criteria for your firm?
Sure. So we started off in India about 2008, December or November actually. It's a wonderful time to start, just after Lehman collapsed. And we were then a subsidiary of Silicon Valley Bank. So SVB was kind of the pioneer of venture debt in the US. Started off about 35 years ago. And a lot of things that Nilesh said, I mean, it's more of a repetition, but to just give you a little bit of context as to how it came about, when massively successful companies like Apple and Cisco and all of these companies were getting created, they obviously needed a lot more equity to build their business, and they were growing very sharply. But one of the realizations was they were using equity for stuff like buying laptops, at that time buying computers, routers and basic hardware, or for purposes which were not seen to be necessarily very valuable. So it started off as a germ of an idea saying, can we have an alternative form of financing for startups or high growth companies where some of their usages, which are not seen to be core, can be met by another form, which is venture debt. It could be leases, it could be direct capital, that's semantics. So SVB did this for about 30 years and started off in India about 7.5 years ago. About 2 years ago, we actually spun out and rebranded ourselves as InnoVen Capital. So now we have Temasek and UOB Singapore as our investors. And between them, they've committed $200 million of equity, along with leverage, because we are a non-bank finance company. We have access to domestic leverage. So the idea is to build a $500 million business by 2020. In terms of approach, we are an Asia-wide platform, have offices in Bombay and Singapore, and China will be next in line. In terms of the product itself, to put it in very, very layman terms, if today, I mean, most people in this room would be founders or engaged in startups. When you go out to raise money, you don't want to raise money for the next 5 years. You don't want to raise money for the next 5 months. So you're trying to raise money for an optimal period of time so that you're not giving too much away in terms of ownership, and you still get enough capital to add value and show that and demonstrate that you've grown as a business. And then you raise money again. So historically, this period is somewhere between 12 and 24 months. If you look at empirical data, that's the time between 2 rounds. So the way that venture debt has been crafted, and we've done almost 125 transactions in India, is if a company has anywhere from 10 to 15 months of runway, can we add some more time so that they can do one of 2 things? One is either you go from 15 months to 18 months, so you have more time, so you improve in value, or you anyways want to raise money in that time period, but can you try a few more experiments in that same time so that you have better answers? And the answers may be positive or negative. So it helps you to know what you shouldn't do in the next round, and it helps you to show, okay, for example, be it a fast food kind of a company where, okay, you've been in a few markets. Can you establish how Bombay behaves versus Bangalore versus Delhi? For a consumer business, that's very important. Versus an analytics company like, say, a Manthan, where it's a SaaS-based model where you're getting clients on board and you need to show better traction, you need to have a better set of employees to open doors in the US. Can you hire those employees, have them on board before your next round? Allows for the company to command a better position. So in a bullish economy, venture debt works to add more steam. It gives you more fuel to execute harder. In a bearish economy, it works as insurance. It's essentially a fallback. In case things don't go to plan, you have a little bit more of oxygen to try and figure out answers. At the end of the day, it provides you time. And that time usually translates to value, or it gives you a lifeline to figure out if you can at least survive. That's, in a sense, what venture debt does. Now, in terms of structure, as Nilesh said, they are a fund. We are an NBFC, so we give loans, and we have a small kicker that works along with loans. So the way we look at this compensation structure is, we are not equity investors. We look at, again, Series A companies. We've been doing this for many years now, and we essentially come in after there's an institutional equity investor who comes on board. And the reason for that is we don't want to take equity risk because we don't get equity returns, or we don't want equity returns. We want the next level of returns, which is still cheaper than equity for the founders, but for traditional banks, it's a much higher chasm that they have to cross to come through the risk hurdle, because they're used to seeing companies which are in cement and steel and commodities and so on. There's assets, profitability, track record, and startups usually have none of the above. It's usually highly passionate individuals with interesting ideas trying to create their legacy in life. So we look for drivers which establish enterprise value. What is going to improve the value of the company, and can we underwrite to that? It could be a brand, it could be a process, it could be a little bit of a timing advantage, it could be a particular contract you have. What it is not is tech IP. This is very apparent in India. So India is really not an environment where tech IP is very strong. So it means it's an execution play, and the team is very important. As with all venture capital investments, the market opportunity is as important. But we also look at what is the kind of stability the company has, the runway the company has, and structure the deal around the situation that the company is in. So net-net, you don't want to take too much risk as a venture debt provider. You don't want to take too little because then it's of no use to the company. So try to find that Goldilocks situation where it's appropriate for the company and they're able to use the money to either showcase something better or get more time to add more value to themselves.
Tell me that both of you has emphasized that, at least you have emphasized also that it buys a little bit of time, plus you can experiment more within that time frame. Both of you, and a little bit of time is a little bit qualitative in nature. What that little bit is enough and meaningful. Tell us that, like in the older scenario when the banks used to debt. So banks debt is largely used by families and promoters in India to save product dilution and product equity. They take debt, they increase their business, they put some collaterals. as compared to venture debt in this scenario is more after Series A, equity dilution has already happened, cash is in the bank. So you guys may not like it, but is it a fear product? Is it like fear product that
It's partially fear, or it drives on fear, but there should be fear, and actually more than fear, there should be paranoia, because as a founder, I think there's two probabilities at work here. There's probability of survival, and there's probability of growth. The VC equity investor is interested in growth, and the reason is out of 10 companies, if one succeeds really, really well, it's power law that returns the fund, right? But for the founder, it's the only company. So the founder has to be paranoid about survival first and then growth next. Without survival, you can't have growth, right? So the product, what venture debt tries to do is inherently improve your probability of survival in some cases, in most cases, and sometimes the probability of growth, right? But the first one is survival. You get more time. More time means you live one day more. You do more in that one day to achieve some growth. I'm saying one day technically, but that's the
Nilesh,
idea.
your views on this, like you get some time, how some is meaningful enough?
Yeah. No, see, I've been a corporate, CFO for many years, and as a CFO, you always look at the cost of capital. And let me just give you a simple math. The notional cost of equity is 30%. Once you've raised equity, you're permanently diluted. And because the venture capital funds have a certain expectation of return, etc., that's where the 30% comes from. Venture debt, between us, we've been lending at about 15, 16%. The interest that the company pays out, assuming the company is making losses, the losses can be carried forward for 8 years. So the effective cost of our debt, post-tax basis, works out to about 10%. So you got a 30% cost of capital, which is equity, and you have 10% cost of capital, which is debt. Obviously, if you have got a mix of the two, your overall cost of capital comes down, which improves the return on equity for all the shareholders, including the founder. So I think it's a no-brainer that if a company, can raise venture debt, it should. That said, let me also, let the audience know that only about 10 to 15% of all venture-backed companies are actually eligible for venture debt. Neither would we want to lend to them, neither would we advise them to borrow from us, because essentially it's an obligation to pay back, and if you can't, then you're putting your business at risk. So I think it is purely simple mathematics. There are things which are, historically better funded, like capital expenses. It doesn't make sense to use equity to fund them. Working capital, receivables finance. In India, we haven't seen leverage buyouts. There's no acquisition finance available either from NBFCs or banks. In fact, they're forbidden. And so, either there's a stock for stock, or in some cases you're using expensive equity, to buy companies. That again, in the West, leverage buyouts are very common. And to have a little bit of that cash coming in from low-cost venture debt makes a lot of sense. So I think there are various use cases for venture debt. I don't know if, one of the major reasons to take on venture debt is fear, about where will I get my next round of funding. But equally, in a lot of companies that, we've supported, we've actually solved their real needs for, working capital or, deposits. Sometimes you have to make a lot of deposits in various government authorities. And again, you don't want to lock in your expensive equity. So I think the needs of companies are very different. Each company is very different, and therefore, at least in our case, no two deals, look similar. There are, about 8 to 10 different levers, that we use to manage the risk better and try to solve, the problem that the company is struggling with.
I think I'll spend one more question and then we'll open it up. Sure. Tell me, debt is a liability product and times are tough now. You have to pay that money, but equity is not coming so easy. Companies are going down with the cash. and all over there is a lot of stress. In those scenarios, how you are helping founders? Is there a lot of stress building in the company? Without taking names, can you take few examples how Trifecta has helped founders to structure it, restructure it? I don't know what's happening.
Yeah, sure. That's a very good question, and I think we are in a down cycle. From a venture capital fundraising perspective, valuations are apparently down 25 to 50%, depending on which sector you're in. And, there is focus on real businesses, real profits. Companies are struggling to raise capital. Those that got lucky raised capital last year and a year ago, they're kind of struggling to raise capital. Deals are taking longer to close. Venture capital funds that are coming in are, negotiating very hard. And in situations like that, where either the founder is already run out of cash, or is going to be running out of cash in, say, 6 months, doesn't want to be in a situation where, he's seen as desperate and is willing to bite any term that a venture capital, prospective fund is throwing at him. I think we're seeing a lot of, such kind of companies and founders come to us and seek venture debt. Clearly for us, it is.
Can you share example in your portfolio how you have helped once debt is there, but cash is now coming, next raise is not happening?
Absolutely.
How you are dealing with that situation?
Absolutely. So we had we have a very interesting, portfolio company in the agri products business. And, they had 4 months of cash, and they had 3 term sheets from very, very large funds. It's a sizable business. They're doing revenues of over 250 crores. But the founder wasn't very happy with the valuation. And he said, Nilesh, if I can get 10, 15 crores of venture debt, that will give me runway for another 8, 9 months, and I will be able to better negotiate with the venture capital funds. Now, because he's been growing aggressively, he has been investing in the business and was not necessarily generating, cash, or did not have a positive EBITDA. So we worked out a structure with him where, in this particular case, the founder was very, more than happy to offer personal guarantees. He had a manufacturing plant where there was land building, plant and machinery, so he was able to offer
mechanism
that.
of collateral or guarantee.
Yeah, so there was something. I mean, obviously, listen, we have to manage our risk, but in a situation like this where the founder was able to offer skin in the game, personal guarantees really, offering skin in the game. I don't even know about the ability to enforce those guarantees, but it has a lot of nuisance
value. There is
value.
something on table.
But we were very confident that the company will be able to close the transaction, and so we went ahead and gave them some debt. Obviously, we tranched it into 2 tranches and just to manage the risk better. But there are others where we've had to decline because we were not so confident that they will be able to raise additional capital.
Vinod, you guys have a long history. Why don't you tell us a couple of examples and tell us interesting one which has worked in your favor and one which has not worked in your favor?
Lots of both, actually, more of the former. See, we've obviously we've seen 3 cycles. Our average tenure is 24 to 36 months. We've been in business for 7 years. I think we look for a couple of things. Broadly, one is whether the adverse development of the company, is it fundamental or structural, or is it temporary? So we had a case where this company was in Andhra Pradesh, and it was a technology accumulating or aggregating company which got data about farmers' credit records and providing it to banks. And the microfinance bill happened, and essentially nobody had any more interest to provide any kind of loans in rural Andhra Pradesh. So overnight, the business model of the company became irrelevant because there was no taker for their product. And their whole USP was, I have exclusive access to data. Now, the company tried to do a bunch of things, and none of them worked out. So we gave them a little bit of time to figure out, and it didn't make any difference to them. And the founder decided that it's not worth his while to continue. The board decided it's not worth their while to continue, and it kind of shut down. This is a risk that we're all paid to take, because if the business model itself implodes, there's nothing anybody can do. right? So this is a fundamental change. There have been a whole slew of, and thankfully we had only maybe 2 like this. So out of 1100 crore, we've actually lost less than 10 crore in the last 7 years. This is one of them. There have been a whole bunch of situations where the issue has been more temporary. Be it, your license gets suspended for 6 months, but comes back on track. Like Nilesh said, rounds getting pushed out, which is the predominant reason, giving the company a period where they need some time and they are running on fumes at that point. It's important to understand what is happening around the business, what is happening in the company. So for example, it's a small network in India. If a company says, I'm speaking to ABC investor, it takes 1 phone call to find out if somebody is serious or they're just shooting the breeze, right? So those variables are important for us to understand whether it's a temporary issue or not. But thankfully, more often than not, these are situations where either the existing investors have stepped up or the company has moved to a very, very low burn path. In some cases, especially B2B, where they decide that growth is not the imperative, survival is. So let me cut down. We have a situation where there was a company in Bangalore, which is essentially into analytics for BFSI sector. 2 years ago, they were hit by a storm. They raised around 2 marquee investors, and they invested a lot in the team and people, and how B2B contracts work. Banks took 6, 9, 12 months to convert. So this kind of a time period meant that their plans went haywire, and they were running on fumes. So it took very, very strong measures internally to rationalize cost, but they emerged out of that profitable. They still needed some support on managing their liquidity and working capital. And today it's become a smaller business, but a profitable business, and hopefully, is in talks to get bought by somebody soon. So these kind of situations also happen, but it needs everybody to be in concert. So my last point here is, to me personally, what is most important is nobody should be second guessing anybody else when there is stress. So there has to be a high level of transparency, there has to be a high level of direct conversation, which is also the reason that we won't do bridges, very short-term bridges. So if there is 3-4 months of runway in a company or 6 months of cash, it doesn't allow us to build a relationship where I'm not second guessing the other person. So I want it to be, if there's 12 months out, there's stress, that's fine, because nobody can look out 12 months and say everything's going to be fine or not. But if it happens 3 months in, I'm wondering whether, I got shortchanged. Did I receive all the inputs I should have received to make the decision? Or is this just, happening out of the blue? So that trust factor is extremely important. In all conversations where there's been stress, that is the first thing which gets tested. Do all the stakeholders, the board, the founders, us, do we trust each other to say exactly what's happening? We've had sessions where we take both the founders and the investors through all the things that will happen over a period of time and the pressure points on us. So we make it very transparent to them, saying these are the pressure points. Up until this, we are okay. Beyond this, we are not okay. Now, what can we do? I mean, how can we resolve this? And we found that it's brought out the best in people. And see, Mukul, fundamentally, debt is about intent and capacity. And what we've seen across all the conversations is, unlike the family businesses, and no disrespect, where across decades you've been taught to kind of don't pay taxes, hide money under, depress your profits. These are situations I'm sure most people, almost everybody in this room, you're all out to create your own legacy, right? Nobody's interested in making a few rupees more or a few millions more if it casts an aspersion on your own reputation. So we've actually had almost no challenges on intent. Capacity, that's the risk we're paid to take. And we've got to work together to figure out where the capacity is.
Thanks, Nilesh. Thanks, Vinod. I think it's a good informative sessions. This is the early days for the ecosystem. It's an interesting product. Entrepreneurs should take advantage of the venture debt scenario.